Hello, friends. In this market update, I am going to take you through predictions, some of the predominant predictions for what is going to happen with the real estate market in 2024. What's going to happen next year? No fancy editing in these market updates. I just start talking and look at some of the data, and in this case, some of the predictions for what's going to happen. So we're going to look at real quick interest rates and where they are, because there's been some recent changes that are playing a role in the housing market right now. And then we're also going to look at kind of a best case scenario prediction for if everything goes well, and a worst case scenario prediction for if everything doesn't, how bad could it get? And additionally, then we're also going to look at the base case scenario, more of a middle of the ground. This is what's likely to happen, at least according to this one large investment bank, Morgan Stanley, who just recently released their predictions. And at the end, I'm going to take you to a different prediction from a very prominent person in, I guess, the real estate finance world, at least over the past, 15 years, who is predicting something they are calling a silver tsunami. Silver tsunami. So stick around for that if you want to know about the silver tsunami, because I certainly do. So first of all, I just wanted to take you, this is being released basically the last day in November. So this is, let's call it a December market update looking into next year. But this is Fred, the St. Louis Fed. I love Fred, and they track all kinds of things when it comes to housing. But this is the 30-year fixed rate mortgage average in the United States. This is mortgage rates since, I'll move myself over here, but basically since the end of 2020, when they were obviously extremely low and stayed low for a while, then shot up. They went all the way to 7.8 in terms of the average, according to Fred. But right now, they have come down significantly. It doesn't look like much on this graphic, on this graph, but basically in late October, so a month ago, 7.8 on average. A lot of folks were seeing over 8% interest rates. That's come down in about a month's time to 7.29. So 7.79 to 7.29, significant drop in mortgage rates. And so the question becomes, well, what's going to happen? Will this keep happening, or is it something that, just keep fluctuating? Is it a trend? Is it a mirage? Is it just part of the normal fluctuation of things? Really what's going on is the Fed has finally signaled a pause in their hiking of the Fed fund rate, which does not control mortgage rates, but mortgage rates react to the Fed fund rate, which is what happened. The Fed started jacking up the Fed fund rate, which caused mortgage rates to go crazy like this, like they have the last year and a half. And so those two things are closely tied together. So the Fed basically said, we're at least going to put a pause on jacking up rates, and we may even cut rates. They haven't signaled that they're going to do that in the near future, but within the next year, that's a possibility. And so you see the mortgage markets reacting, and rates are coming down to a more palatable range. So that's what's going on right now. Now, if you've watched this channel before, I've told you about kind of all the incentives that are available to buyers because of the slower real estate market right now, both because of these economic factors and just time of year being later in the year. A lot of those things are going to change when we get into our spring selling season. How much they change is up to anyone. What we can reasonably predict is a lot of the seller concessions and price cuts that are happening on a lot of these houses will either go down or go away to some degree. Right now, right around 50% of the homes that go under contract in the Denver metro had at least one price reduction. Right around half. Very interesting trend. So there's opportunities for buyers right now. There's obviously not a ton of inventory either, so it's kind of a tough time for everybody, depending on what you're looking to do. The other thing that happens a lot that I've talked to ad nauseum, so I won't go all into it, but is those seller concessions that you can use, cash concessions you can use to buy down your rate. A lot of buyers are taking advantage of that right now. But looking forward to the next year. So Morgan Stanley, this is a Newsweek article that talked about Morgan Stanley just releasing their predictions for the housing market next year, considering two possible scenarios, one where the U.S. economy enters a bull market and one where it descends into a bear market. So what's going to happen? They talk about mortgage rates had dropped for 3 consecutive weeks as of last week, showing that the market was reacting to the Federal Reserve's pause of aggressive rate hikes. That's what we just talked about. So in its base case scenario, what they think is the most likely to occur, Morgan Stanley expects the new year to bring good news for aspiring home buyers who've been struggling with skyrocketing house prices and higher mortgages. And so they expect home prices to come come down a little bit in their base case scenario over the next year to make homes a little bit more affordable. This would be good news for anybody looking to buy a home. So according to the latest updated forecast, I'm not going to go into the full forecast because it's not very pretty and it's a big report, but we're just going to look at the summary here. I'll spare you. The investment bank, Morgan Stanley, expect home prices in the U.S. to fall on average by 3% across the country. So worth talking about too. National housing market and local housing markets often don't follow the same pattern. Typically, they follow a similar pattern, but if home prices fall 3% on average across the country, that might mean they're falling 9% somewhere and falling 0%, staying flat somewhere else, or even rising a little bit. Here in the Denver metro, real estate has been stronger than the national average, so we've been more resilient to some of these drops. We'll see if that'll continue, but inventory is still so low. It's unlikely to see a major drop. Could we see a tepid drop? It's possible. More likely here would probably be, say, flat over the year, or flat or maybe 1-2% increase, a much smaller increase than we're used to seeing. So there is a quote from Morgan Stanley. They expect home prices to fall modestly as housing activity picks up versus 2023. New home sales outpacing existing sales, but they think strong fundamentals of existing homeowners will prevent sizable corrections. So not a huge correction or crash, which many have been waiting for since the dawn of time. They quote Zillow here. We don't need to look at that. So let's look at the bear case scenario, where bear almost looks like best. It's only 2 letters. 2 letters similar, 2 letters off, but it's not. It's the worst case scenario. The bear case scenario is home prices nationally drop by 8%. This according to Morgan Stanley. So this is what they think could happen if the U.S. economy enters a downturn next year, like a full-on economic recession, but which they think is unlikely. In this case, they expect home prices to drop by as much as 8%. Basically, they're saying if mortgage rates remain high and the economy goes into a recession and rates stay high, demand for housing could soften. So that would mean home prices would drop. This would be very good news for anybody who's looking to buy a home. Not great news for the overall economy, which affects everybody, but it is a possibility. They also mentioned, they don't expect defaults and foreclosures, and thus distressed transactions will increase significantly. Meaning, we talked about this before in a different video, but when we look at a widespread crash and a foreclosure crisis, people being foreclosed upon, which is like what happened in 2008, that is unlikely because people have so much equity in their homes, number one, and because the majority of homeowners are locked in at a good interest rate in the United States. You see 7-8%, all this stuff, and go, oh, wow, everybody has that mortgage. No, it's like over 70% of homeowners have a mortgage that's in the 4s or lower, meaning their monthly payment is significantly more palatable than something that's 7 or 8%. So even if they come on hard times, number one, they could have plenty of equity in their home, or number two, they could easily rent that home and cover that monthly payment, which would avoid the possibility of a foreclosure. So that is the worst case scenario. The bull case scenario, the true best case scenario, is up 5% nationally. That's what Morgan Stanley thinks. In this world, they envision steady economic job growth in the U.S. leading to a rise in the stock market. So everything kind of going up, jobs reports going up, stock market going up, economy is getting better. They expect a rise of 5% in home prices. So they say with so many housing statistics at levels they've rarely seen over the past several decades, not hard to envision housing activity and home prices evolving differently from what we've laid out above in the bear case scenario. Basically what they're saying is, listen, there's a lot of economic factors that have transpired over the last few years. COVID, some people say we're in a recession, interest rates being hiked dramatically. Home prices have remained pretty resilient. They're down from their all-time highs in, say, June of 2022, but they still haven't come down a lot, and certainly haven't come down as much as some folks have expected or hoped for. As mortgage rates come down, affordability will remain under substantial pressure because mortgage rates coming down, more buyers are in the market, and home prices could stay high or even go higher. However, a consumer that's recently seen mortgage rates above 8% might jump at a chance to lock in 6.5% or 7% mortgages in greater numbers than we were expecting. This is another important point too, and this is something we're seeing as we monitor the activity of mortgage rates and activity in the housing market. Consumers we're finding are more sensitive to changes in mortgage interest rates than they are to the rate themselves. Meaning, if a rate is at 8% and then it suddenly goes down to 7%, that will bring more consumers out. That feels good rather than going from 6% to 7%, right? In both cases, we're ending at 7%. But in one case, the change is a lot better. In the other case, the change is a lot worse. Psychologically, that plays a different role in people's minds. And so we're seeing, basically what we're seeing is that the net change in mortgage rates matters more than the rate itself. Obviously, there's real tangible considerations with the rate itself because it plays so much into affordability and monthly payment. But if demand increases more than we're expecting into a supply environment or the supply environment remains constrained, we envision home prices climbing a further 5% next year to a new record high, which could happen. That is the way it's laid out for Goldman Sachs. Now, let's look at the silver tsunami scenario, as it were. Okay, so this is a bold headline. A silver tsunami is about to upend the housing market, says an analyst who accurately predicted the 2008 financial crisis. So the analyst is this gal, Meredith Whitney. Don't want to mess with her. I don't. Do you? Look at her. I mean, she's tough, and she correctly predicted the 2008 crash. Get out of here, entrepreneur, which very few people did. So key takeaways. Meredith Whitney predicts housing prices will decrease and the supply of homes for sale will increase starting in 2024 due to a silver tsunami of baby boomers downsizing. Finally, downsizing is what Meredith Whitney expects. Baby boomers, this is one of the reasons supplies remain so low because baby boomers is this big generation, right? And they're at the age where people traditionally downsize into smaller homes. Well, if you're downsizing, you're selling a home and buying a new one or selling a home and moving into an apartment or something like that. Point is, you're selling a home. For a lot of reasons, and it kind of started with COVID, baby boomers aren't doing that so much. At COVID, things were so up in the air. A lot of people didn't want people coming through their houses. A lot of people, didn't want exposure to the germs and things like that, especially in those older demographics. Okay, and that has sort of continued as a lot of these folks are just finding out they're okay staying put in their homes, and that's keeping supply constricted in a lot of these markets. So more than 30 million units of housing are expected to be brought onto the market as 51% of people over 50 who own more than 70% of U.S. homes downsize to smaller homes. So you see, that is a significant population. And if they are starting to downsize and starting to sell those homes, that will shake loose inventory quite a bit. That is what she's calling the silver tsunami. So Meredith is known as the Oracle of Wall Street because she predicted the 2008 financial crisis. So that is who knows if this is true, but she's got some cachet there. Worth keeping in mind, just because you predict one thing doesn't mean you'll predict the next thing, right? Another person who predicted and actually bet on the 2008 housing crash, Michael Burry, who's profiled in The Big Short, a few years ago, he took out a really big bet, a big short position, essentially betting against Tesla stock. Now, if you know anything about Tesla stock or watch the stock market, you know that bet didn't pay off. So it can go either way. What does Meredith say here? So she's just highlighting the AARP and saying that it's finally time. Over half of individuals age 50 or above are projected to move into smaller residences. She just thinks it's going to happen. I'm sure they have all kind of models that account for this. I don't really know. But if that happens, that is going to shift things considerably. I don't know if it would cause a silver tsunami, but that would shake loose inventory in a major way that kind of the housing market's been missing and would be very good for folks who are looking to buy. Not so good for folks who are monitoring the equity of their home, but keep in mind, home ownership is a long-term play. This is not day trading, okay? So if it's like, price of my home is down year over year, well, are you going to sell it? If you are, then that may be a challenge. Do you still have equity in it? Great. And if you don't have to sell it, just keep living in it. That's the thing. A house is an investment. It's a special type of investment, but it's an investment like any investment, and like any investment, they don't go up every single year. There's ebbs and flows. Over time, the graph always goes up, or at least it always has, if you wait long enough. But there are ebbs and flows. And so this rapid appreciation we saw happen starting in 2020 and going through the middle of 2022, that's not normal. So folks are like, my house isn't up 10% year over year. Well, yeah, it'd be nice if it was, but that's not a normal thing. A normal thing is for 2 to 4% average appreciation year over year, and for that to keep going. Sometimes it's going to be 5%, sometimes it's going to be 0, somewhere in there. That's a much more normal world. So this is what we could see for next year. Maybe a small decrease, maybe a sizable increase, maybe a sizable decrease. I'm not really telling anything. Basically, other than there are a few different models of what's going to happen. This silver tsunami theory, I guess, is very interesting to me. Personally, I'm not here to bet against Whitney, but it seems like it's going to take a little longer than for that to all of a sudden happen in 2024, because just this hasn't happened yet. So all of a sudden, all these people decide, this massive part of the population decide to sell in 2024. It'd be surprising, but the trend may start. Or if the economy continues to grow and rates don't go up too much, home prices could go up. As far as the sort of middle of the road expectation for the Denver market, nothing against Meredith, but I'll just talk straight to you. For the Denver market next year, I've always said that we should expect 1 to 4% appreciation over the next year. I don't expect it to drop just because of what we're seeing with supply. And supply is actually staying low for this time of year. It's not going up as much as it could have. And in the spring, more buyers are going to come out. That's just the truth, because it's a heavier buying season. And assuming rates don't go way up, even if they stay where they're at, people are getting more used to it. People are more sensitive, as I mentioned before, to the change in rate versus the rate itself. So even if it's buyers are getting a rate at 7% or even 6.5%, that's going to feel pretty good compared to a lot of this stuff we've seen. So inventory should remain low for the most part, because a lot of people, there's the baby boomers, but then a lot of people just in general don't want to sell their home that they have a 3% interest rate on and then go get one, even if it's at 6.5%. That's a big problem with this supply issue we've been having lately too. That, at least to some degree, is likely to continue. And there's going to be opportunities for buyers and sellers, like there always are. But it should be a decent time to sell your home if you need to sell. Everybody's worried about, did I miss it? Did I miss the wave? Did I miss the very peak? Yeah, you missed the very peak, at least for now. But most people that are transacting right now, most people that are selling their home, there's a life reason to sell that home. And it's going to be the same situation next year, where you're going to have a reason in your life. You're going to move, you're relocate for your job, you need more space, your family's growing, something like that, where you'll have should be a good opportunity to still access that equity in your home, so long as you're doing it the right way, so long as you're listing with a professional that markets your property correctly, presents it correctly, advises on staging and timing and all those other things. It's a good time to say, because I haven't before. If you made it this far, I love you. And also, I'm obviously a licensed real estate agent here in Denver. I would love to be your go-to, your real estate agent of choice for anything that you might need, even if it's just a conversation. That is my goal with this channel. So thanks for hanging out with me, and we'll talk soon.